Hello, welcome. This is Yee from the Yee Real Estate Network. Today's topics, I'm going to share you one thing. As a real estate investor, if you're a typical mom and pop individual real estate investor, right? Middle class investor, wherever you're located, where you in any part of the US, if you are living in a very expensive real estate market, you need to look outside your comfort zone, all right? So we've been doing this for many, many years, more than 20 years. We have helped mom and pop real estate investors from all over the country to buy great properties in the best areas of the country, cash flow markets. So here's the one thing you need to learn, and that's all you need. It does not matter what's going on in the economy, in the mortgage world, all the doom and gloom, all the negative headlines we've been observing. So you need to just do your best to ignore them. Okay. What you've been hearing, all the real estate news applies to primary home buyers, owner-occupied buyers, where everything is based on your payment, right? A typical owner-occupied primary home buyers, they buy based on payment, based on the interest rate. If the interest rate is low, historical low, like a year ago or whatever, at 3%, that creates a tremendous amount of demand, tremendous amount of primary home buyers, because your mortgage payment is so low, it allows you to buy properties. And that's what happened in the past few years during the pandemic. Now, when the interest rate has skyrocketed in the past few months from 3% to maybe 5 to 6%, then your mortgage payment is twice the amount, right, from the previous interest rate. So that'll take away a lot of buyers, right? But my message today is not about owner-occupied primary home buyers, first-time home buyers, whatever. No, my message to you is, as a real estate investor, what is the most important criteria in order to achieve success long-term, to create real estate wealth, right? And my answer is your down payment. Your down payment. If you're buying a single family home investment property, the down payment typically is around 20 to 25% down payment. That's the benchmark. If you're buying a 2-unit to 4-unit, a multi-unit, for example, 2 to 4 units or even higher, the minimum down payment is 25% down payment. So the next criteria you need to determine, as I share my screen right here, is you need to use the benchmark of, let's put it 25% down payment. I know today's interest rate for risk investors is around 6%, give or take, right? We don't know. The interest rate could be higher later this year or could be lower. We don't know, but let's use a 6% interest rate. As a risk investor, I will share with you later how your interest rate is just part of the cash flow calculation. It's not a primary driver to become successful as an investor. Okay, I will explain that momentarily. But look at this chart, this slideshow. Cash flow is king. Again, you need to find a real estate market in a particular part of the country where you can find a property that matches the rent, right? I'll share with you later, momentarily. So you need to buy at 20 to 25% down payment. You need to, cash flow is king. This means the rent, the monthly rent, the gross monthly rent need to be higher than your monthly property taxes, which is your debt obligations, your monthly mortgage payments, and your monthly insurance, property management fee, if that's what you want to do with the if you can have your property managed by someone, and then even factor in 5 to 8% vacancy, or factor in 5% maintenance issues, and then at the end of the month, you at 20 to 25% down payment, even at a 6% interest rate for investor, you should have monthly positive cash flow. Doesn't have to be that large. Could be $100 per month net, could be $200 per month net, could be more. But that's a benchmark. Cash flow is king. And of course, for each property you buy, you should have anywhere from 6 to 8 months of PITI, principal, interest, tax, and insurance, in case any of the issues occur in your rental property. And over time, things will happen, right? Maintenance, vacancy, what have you. So cash reserve are vital, right? To create a safety net for you. And don't over leverage, right? Again, 20 to 25% down payment is an ideal down payment for real estate investors. So don't over leverage. Watch your debt to income ratio as you continue to buy properties beyond 1, right? Hopefully more than 1, right? And financing can disappear, right? Financing always have been changing, but now, you're able to get Fannie Mae lending guidelines for primary investors for up to 10 mortgages. 1 unit is 1 mortgage per individual. If you buy 2 to 4 units, that's also 1 mortgage. So you can be able to buy more doors per mortgage, right? You can buy 1 to 4 units under the Fannie Mae lending guideline equals 1 mortgage per person. So you can buy up to 10 mortgages per individual. If your spouse also qualified to get a loan, then if you're really ambitious, after your 10 mortgage has expired, then you can use your spouse to buy the next 10 properties using the favorable Fannie Mae lending guidelines of 10 mortgages per person, and so forth and so on. All right. So again, I tell you again. So let's assume that you're able to find a property that will meet the blueprint, right? So the best type of single family home property you can buy needs to be less than 400,000, given what's going on in today's real estate market. So I just happened to pick this property in Florida. It doesn't matter where. I'll tell you where. I may or may not tell you where on this podcast, but you will want to learn further on a specific market. You can join our newsletter, free newsletter, sign up by entering our website. But anyway, this is an example. Give you some great education, the real world, what have you. So this is a real property. So you need to find a market that job growth, population growth, top 10 growth, whatever, right? Those typical metrics. In this case, the single family home located in Florida is 310,000, right? And the rent is 2,200. So far, you're getting a rent to value ratio of 0.7%, which is good. 7% multiplied by $310,000 purchase price equals a monthly rent of $2,200. So at 25% down payment, even at 6%, you see, now as a real estate investor, your mortgage payment is part of the debt obligations, is part of your monthly expenses, is part of your annual expenses. As long as your gross rent, which in this case is $2,200, right here, gross monthly rent $2,200, and if your taxes monthly is $267, insurance $67, property management fee 8% multiplied by your rent is $172, then and then your mortgage, even at 6%. See, don't freak out just because your interest rate higher. Investors use a completely different criteria in order to be successful. You're not a primary homeowner. You are a tried and true real estate investor. Your interest rate, your mortgage, of course, we don't want a 6% interest rate. We'd rather have a lower interest rate so we can get more cash flow. We all want that. But today's reality, it is what it is. Deal with it, right? It does not mean that you should sit on the sideline, because 6% is still on a historical 40-year average on the mortgage interest rate is low. All right, it's low. It's back in the early 1980s, the mortgage rate was as high as 18%. All right, so don't worry about that. So your interest rate equal your monthly mortgage, which is in this case 1320, is part of your debt obligations. Your monthly mortgage 1320 at 6% interest rate, whatever, minus your other monthly debts, taxes, insurance, property management fee, whatever, maintenance, vacancy factors, but your $2,200 will exceed all your debt obligations. And at the end of the month, you will achieve approximately $339 monthly cash flow. That is what you look for, okay? I can go further, I don't want to. I want to make this presentation as simple as possible, but all the numerical metrics make sense, okay? On another educational module, I'm going to talk about capitalization rate. I'm going to talk about cash on cash return. I'm going to talk about total ROI. But all these numbers you can see right here. Cap rate 6.4, cash on cash return of 5%, right? Total return on investment is 46% based on the appreciation rate of 10% in the next few years. It could happen, right? But anyway, you get the idea. The most important thing is I just share with you, the numbers I share with you is only the first year projection. But the beauty of buying investment property and the reason why investment people have become wealthy using real estate over the years are greater than any other investment asset class. So I will leave you for the next few minutes why real estate has been the greatest wealth building vehicle in history, all right? So if you want to participate, you have to overcome a lot of things. But I'll conclude this presentation with this very good level. Just take a step back. Just, look at the history. Income property is the ideal investment. Ideal means I stands for income, D means depreciation, E means equity growth, A means appreciation, and L means leverage. Your income property, whether you buy single family home investing or duplex or triplex or fourplex or multi-units or what apartment building, whatever, is history's most powerful and proven multi-dimensional real estate asset class, right? And it's also is the most tax efficient investment asset class in history as well, right? Because there are multiple ways you can make money when you buy investment property, when you buy income property. Cash flow is just one component of it, right? So too many investors, newbies, and even experienced investors over the years, they do their first year cash flow analysis, and if the cash flow is a little bit too low, that is lower than their expectation, they decide not to buy. No, when you evaluate an investment property, you have to look at all the multiple ways you can make money above and beyond even slight positive cash flow you may have, because not only you can receive the income over time, cash flow, which will increase with the rate of inflation. You can raise your rent hopefully every year 3 to 5% or more, right? That's income component of it. You can get more cash flow down the road, assuming you do the right thing. Then depreciation. Depreciation is a phantom tax write-off, right? So you can decrease your real estate income subject to ordinary taxation by depreciating your assets over time annually, little by little, on a 27 and a half year depreciation basis. I'm not gonna go over tax benefits because it'll take another education module to discuss that. Besides, I'm not a tax advisor. I cannot give you tax advice, but there are, additionally, you can get tax deductions, all your debt obligations on your rental tax return or deductible against your rental income. So at the end of the day, the more tax deductions you get on a monthly and annual basis, the less taxes you have to pay on your real estate properties. Plus, you can get some bonus depreciation, you can get some cost segregation, and what have you. And also, the other tax benefit is over time, you can do cash out refinance of your rental property. Once you achieve sufficient equity, when you do a cash out refinance of your rental properties to buy more properties or to retire, whatever, the cash out refinance is tax-free, right? Another tax benefit. And then you can also do 1031 tax-free exchange. When you sell your current investment property, as long as you replace the property with a newer property, your capital gains are deferred, right? So, and then once you pass, your property will be categorized as a step up in basis. That means you don't have to pay any taxes upon your demise, right? You can do a estate transfer free of taxes on your real estate portfolio to your beneficiaries. Again, I'm not a tax advisor, but consult one to go over your unique situation, right? So that is tremendous tax benefit, which other investment asset class you may not get the similar one, right? Stocks and bonds, mutual funds, whatever, you're not gonna get these kind of things. And equity growth, right? Real estate historically has outpaced inflation. Real estate investing is a hedge against inflation, all right? See what's going on today? Equity growth, on a long-term historical equity growth over many, many years is around 5 to 7% equity appreciation on an annual basis. From time to time, you get 20 to 30% appreciation, like you have been getting, many of you have gotten when you invest, if you bought properties in the last couple of years during the pandemic. I have to assume you'll see massive amount of equity appreciation, but don't expect 20, 30, 40% appreciation like we did in this past few years. But buy for the long term, your property will grow very nicely, all right? Then appreciation, same thing, and leverage, right? No other asset class to allow you to put, 20 to 25% down payment, and a lender will leverage against the rest of your purchase, right? Isn't it amazing? That's the power of leverage, the power of OPM, using other people's money. So if you have great credit, wow, that is such an amazing things to have. You're able to, the lender will be able to trust you. They will leverage your investment, and you can, when you leverage your rental properties, the returns on investments is a lot higher, right? At the end of the day, that's what you get, right? So to recap, is this, that the one thing you should learn from this presentation is that all you need is your down payment. All you need is a down payment, 20 to 25% down payment. That's the benchmark. Once you have your down payment put away, allocated, get your financing, right? Put your team together, put your property management team, whoever market you're buying, and then get the renter in. The renter will make you rich, right? The renter can pay off your debt, right? Over time, your mortgage, your rental income is going to increase over time, giving you more cash flow down the road. You can get equity appreciation systematically over the long haul, right? The renter going to pay down your 30-year mortgage, systematically speaking, right? And then, and you get tax benefit, the whole 9 yards. So you put your 20 to 25% down payment, and the rest of your investment is for the most part, will achieve your goals, right? Just let other people do the heavy lifting. The only heavy lifting for you is to have the 20 to 25% down payment, identify the property you're going to buy, find, in good markets in the country, find your team, and then the rest is hopefully smooth sailing for you. So hopefully this helped. Thank you so much. And thank you so much to see Yee from the Yee Real Estate Network. Good luck. Have a nice day. Bye-bye.